There is a possibility that we might increase our stake in an associate, and such increase is a combination of cash and shares or other assets. But what is much more important to us is the cash aspect of it, which means whatever the cash inflow or cash impact will be on increasing or adding to our investment in an associate will also have to be identified and accounted for. Likewise, we might reduce our stake in an associate that results in disposal of partial interest in associates, which also constitutes a reduction in an associate. Such also, the cash flow impact of it will have to be accounted for in our consolidated statement of cash flows. The question then is, how do we go about that? Is for us to also look at this example. Now, as I've said earlier, if you look at associates, it is an asset. And on that premise, it has a debit balance. For every dividend due from an associate that we are yet to receive, constitute a debit balance, which is a dividend receivable. Likewise, our stake, equity stake in the associate, also constitute a balance, as the case may be. Now, when we share profit in an associate, it increases our investments. That's why it's debited. Otherwise, when we make loss in an associate, it reduces our balance. That's why it's credited here. And similarly, the sum of our opening balance and share of profit or loss in an associate should equal our closing balance in the consolidated statement of financial position. But where it does not, we can easily attribute same to dividend that we might have received from an associate, which represents the balancing figure. And the same thing is what we reflected in the vertical. And within the vertical, we more or less consider it by adding profit to increase our stake in the associates, opening balance, or reduce the stake by share of loss. And we compare that with our balance in our balance sheet to determine whether dividend has been received further from an associate. On that premise, I will equally want someone to read this question. But before then, let me copy the question to our Excel workbook so that I can take it off from there. Okay. Let me copy the balance of the question. Okay, who is the volunteer? Who has chosen to volunteer? Can you raise up your hand, please, so that I can give you access? Who is going to volunteer? Okay. Chibueze, kindly unmute. Are you there? Okay. If Chibeze is not responding, Iyanu, can you unmute? Can you unmute? Okay. Jonathan, kindly unmute.
Illustration 2. The following is an extract from the consolidated financial statements of Lilly for the year ended 31st December 2018. Consolidated statement of profit or loss, operating profit, share of associate profit after tax of 108,000, profit before tax, parent and subsidiary profit for the year. Consolidated financial position, investments in associates, carrying amounts, loans to associates, current assets, receivables. Included in the group receivables are the following amounts: dividend receivable from associates, current accounts with associates, required, show the relevant figures to be included in the consolidated statement of cash flows under appropriate heading activity for the year ended at 1st December 2018, and the amount at which account receivable will be shown in the reconciliation of profit to net cash flows.
Okay. Thank you very much. Now, in similar vein, we'll replicate the same thing for associates. Now, I've tried to copy the template so that I don't waste more time in building the template again. Now, you can see my screen now. Now, I've simply come in to say, okay, the associate, what was my opening balance? My opening balance, as you have seen, you could see that now in this question, the order was changed. Therefore, don't be deceived by the examiner. They can present it in any order. Current year might come first, and previous year might come first. In this case, this is my prior year. This is my current year. Therefore, my opening balance, based on the carrying amount, is 912. And for dividend, is 58. Therefore, the carrying amount is 912, which is brought forward, and also the dividend brought forward is 58. And that gives me 970. During the year, there's a share of profit after tax from the associates. And what is that? The profit share in the current year is 136, all things being what? Equal. And therefore, I put 136. That gives me 1,106, of which we are aware that at the end of the year, the amount of the carrying amount is what? 932. And for dividend is what? 96. Therefore, I have 932 and I have what? 96. Now, the two I have to compare. What I expect my balance to be, all things being equal, after aggregating the share of profit this year with my opening balance, supposed to be 1106. But what is reported in my balance sheet at the end of the year is 1028. All other things being equal, the only thing that will have reduced my balance is the amount of dividend I've received from the associates in that year, which in this case, the difference is 78. And that is that. Now, similar to what we did under NCI, we asked these two questions and try to answer it. What are the two questions we need to answer? How do we treat the dividend received from associates? And remember, associate is an investment similar to financial assets. Therefore, the activity is investing activity. And dividend we receive result in an inflow of cash. And therefore, we treat it as what? An inflow of what? Of cash. And that is the position there. But we have not finished the question. Remember that we also talked about the fact that there are other transactions that will have occurred between the associates and the parent. And one of them is loan to associates. The loan given to associates, how do we treat it? How do we treat loan to what? Associates. In similar vein, we look for the movement. At the beginning of the year, the loan we have in associates was 600. At the end of the year, the loan has now increased to 760, which means the increase in loan from the group to the associates stood at the difference between 760 and what? 600. And when we look at the difference, 760 minus 600 is 160. Therefore, this 160, how do we treat it? In similar vein, we treat it as investing activity, but in this case, it's an outflow of cash. Why is it an outflow? We are giving more money out to the associates rather than taking more money in from the associates. And that is what you can see in this case. That's what you can see in this case. Okay. Now, the question then is, how do we treat other concerns? What are other concerns do we have here? I'll highlight them in yellow. Included in group receivable are the following items. Current account with associates. And what does that mean? It means there's a possibility of transaction, trading transaction between the associate and any member of the group, so that the associate purchase goods from the member of the group or the associate sell goods to the member of the group. Now, that constitutes payable and receivable, as the case may be. Okay? Such, in line with any other intercompany trade receivable and payable, they will constitute adjustment we made within working capital, which means if you go back, we'll talk about movement in working capital in our beginning notes. Remember, for the indirect method, we talk about movement in working what? Capital. And such will constitute movement in working capital. But what was the question asked? Again, they said, show the relevant figures to be included in consolidated statement of cash flow under the appropriate heading or activity for the year ended December 31st, 2018, and the amount at which account receivable will be shown in the reconciliation of profit to net asset, which means they also want us to show the movement in account or trade receivable. Therefore, how do we do that? Okay. Now, what is my group trade receivable? A group trade receivable we have to exclude items that we have already considered on the separate line. And what are we going to exclude? Remember, we have already used up the dividend receivable from associates. Therefore, what will I do in this case? I'll strike it out. Therefore, I'm going to strike this out, which means since it's included in the receivable and I've already used up 58 and 96, therefore, I exclude dividend receivable from associates. And what that simply means is this balance which is for the beginning of the year is 380. I should remove dividend receivable from associates, and that is how much? That's 58 at the beginning of the year. What is left? Is 323. Okay. I'll compare that at the beginning of the year. with the same thing at the end of the year. And we'll find the movement. Okay. Now, what is the end of the year for trade receivable? End of the year, if I pick my pen, is 520. Remember, we dealt with 380 before. 520. And let us take out the 96, similar to how we took out the 58. But the 96 is at the end of the year. Therefore, 96, we take it out. This is 424. Now I'll compare the difference between that and see what it is. What do we call this difference? That's the next question we ask. That difference constitutes movement in group trade receivables. But this movement, is it increase or decrease? Now, the trade receivable at the beginning is 322. At the end is 424. That constitutes increase in account of trade receivable. And the next question we ask, similar to where we started from, is this. This treatment. How do we treat? How do we treat increase or movement? In trades or account receivable. Now remember, working capital constitutes part of operating activity. Therefore, we will treat this as operating activity. And if you have increase in your trade receivable, it's more or less, or it's tantamount to you more or less giving out cash or lending out money to your customer. And therefore, that results in outflow of cash. That results in what? Outflow of cash. And that is the treatment we are giving that. Any question? Any question? Now, that means we've crossed the 2 orders out of the 4. The first one is treatment of non-controlling interest. The second one is how do we treat investments in associate or joint venture and the associated transaction in that. Any question? If not, we can go back to our notes. Acquisition and disposal of interest in subsidiary. How do we treat it? Though at this level, within the group account, we never dealt with acquisition or disposal of stake. in a subsidiary. It is for the next level at strategic business reporting. But within the statement of cash flow, what if you are confronted with issue that borders on the fact that at the beginning of the year, you had a parent and two subsidiaries. And at the end of the year, you now have a parent and one subsidiary, which means during the year, one of the subsidiaries was disposed of. What impact of that have or would that have on our consolidated statement of cash flow? Conversely, at the beginning of the year, you have the parent and one subsidiary. And at the end of the year, you close out with one parent and two subsidiaries, which signifies that during the year, there's an addition of one subsidiary. The question then is, what impact would that have on our statement of cash flows? And that's what we want to discuss. But I want somebody to volunteer to read this expression first before I use illustration to explain the impact and the strategy or gimmick to extracting the cash flow impact and the treatment of same within the consolidated statement of financial position. Who will volunteer at this point in time to read this expression? Who will volunteer? Kindly show up your hand, please, so that I can accept you. Who will volunteer? I can't see any hands up. Uche, can you unmute? Are you there, Uche? I've given access to unmute. Okay, Jonathan, can you proceed?
Illustration 3. Given the following information.
No, not the illustration. I want you to read the narrative.
Okay. Acquisition and disposal of subsidiary during the year. Where a subsidiary joins or leaves a group during the financial year, the cash flows of the group should always include the cash flows of the subsidiary concerned for the same period as at that for which the group's income statement, which includes the results of the subsidiary, that is, from the date control exists or control is lost, or part of the holdings in the subsidiary is disposed of. Payments to acquire subsidiaries and receipts from disposals of subsidiaries must be reported separately in the statement of cash flows under investing activities. They are reported in the statement of cash flows net of cash and cash equivalents acquired or disposed of. A note to the statement of cash flows should also show summary of the effects of acquisition and disposals of subsidiaries, disclosing A. The total assets or disposal consideration, B. The amount of cash and cash equivalents included in the purchase or disposal consideration, C. The amount of cash and cash equivalents in the subsidiary acquired or disposed of, D. The amount of the assets and liabilities other than cash or cash equivalents in the subsidiary acquired or disposed of, summarized by each major category. Implication of acquisition or disposal of subsidiary on consolidated statement of cash flows. The substance of an acquisition of a subsidiary is that the group has purchased the assets of the subsidiary. However, in statement of cash flows, we only wish to record the actual cash flows. Thus, for example, the additional non-current assets under the control of the group as a result of the acquisition will not be separately stated under the heading investing activities. Due care needs to be taken when expenditure on non-current assets is derived as a balancing figure. Non-current assets of the subsidiary at acquisition must be included in the ledger accounts used to derive the balancing figure. The same caution is required for other sales and liabilities in the subsidiary at acquisition.
Okay, thank you. Now use that to read the illustration, and I can now use that to explain all the narratives that you read earlier.
Illustration 3. Given the following information, group inventory, including subsidiary acquired in the year as at 31st December 2009, 500,000. Group inventory, excluding subsidiary acquired in the year as at 31st December 2008, 400,000. Subsidiaries inventory, which is included in the net assets acquired in the year, 30,000.
Okay, what then is the question?
What will be the increase or decrease to be shown as a reconciliation of group profit before tax to net cash inflows?
Okay, from the operating activities. Okay, thank you. Now, thank you, Jonathan. Now, what we are simply saying is this. We have group inventory, which constitutes part of working capital within the operating activities when we conduct indirect method. The question then is, naturally, under single entity, you will have just picked the inventory amount at the beginning and compared with the inventory amount at the end to determine whether there's an increase or decrease in inventory. But in this case, it will not be appropriate. Why? Let me show you. At the beginning of the year, this was a group structure. At the beginning of the year, which is boy, you have parents and subsidiary one that make up the group. But at the end of the year, that's the reporting date, is now P plus the same S1, but now during the year we've added what? S2. Therefore, the group now is enlarged. The question then is, are they comparable? The answer is what? No. Both are not comparable. We are not comparing apple with apple. Maybe you are comparing apple with oranges, or you are comparing red apple with green apple. Therefore, if we go by this, we can't just say the movement either increase or decrease in the group inventory is the difference between 500,000, which is at the end, and what? And 400,000. which is at the beginning. That would be a wrong philosophy. Therefore, what do? There are two approaches we can use. The first approach is to say, first approach. Let us assume that as we have P at the beginning and S1 at the beginning, and we have at the end P, S1 and what? S2. Therefore, we need to do something, which means we need to find a way of bringing S2 at the point of acquisition. You know, this is at the beginning of the year, but this is during the year, sometimes at the point of what? Acquisition. Which then means the fair value of the inventory that is part of asset acquired have to be adjusted for by adding it to the opening inventory so that we can compare the movement in an appropriate manner. Which then means that what this approach is saying is that for me to determine my movement, similar to what I did here, movement here, movement in group inventory. Therefore, what will I do is that the group inventory brought forward will have to adjust for the fair value of the acquired inventory in the year. Acquired subsidiaries what? Inventory in that year. Okay, which then means that if that is the case, the inventory brought forward was 400,000. Now, I then need to adjust for the fair value of the acquired subsidiaries inventory. Now, at the point of we acquiring the subsidiary inventory, the inventory included this 30,000. And this 30,000 will be added to the open inventory to give us 430. We will now compare that with the closing inventory, which already has P, S1, and S2. At that point, it makes it comparable. And what is that? 500. Now I can now compare 500,000 with 430,000. And what does that give me? What is the movement? 430, 500. Therefore, there is an increase in the amount of inventory by how much? 70. If we have not adjusted for this, which I'll put in red, if we have not adjusted for this 30, you would have wrongly believed that the increase in inventory was 100, whereas it is not true. Why? Because you are not comparing them on the same scale. Why? This 500 is made up of P, S1, and S2, whereas this 400 is made up of P and S1. Therefore, they are not on the same scale, or because all things being equal, assuming this inventory has not been sold at the end of the year, this 430 and this 30 is already in 500. And that is what's going to lead me to, that's what's going to lead me to the second approach. Now, I told you there are two approaches. Now, the second approach is the same thing, but I'll say, since I'm aware that at the beginning of the year, I have P and S1 alone, which give me the group. At the end of the year, I have P, S1, and what? S2 to make up the group. To make it comparable, I will delete S2 or remove S2 to make it comparable. And therefore, what will I do? I will cancel S2 out by removing it. And how do I do that? Let me do the same thing and see whether I'll get the same result. I will leave the beginning and I'll adjust it by deleting it at the end. Which means in this case, there's nothing here. This is my 400. And I'll come here to compare that with the adjustments I made earlier, which means instead of adding, I will delete. Delete means I remove. Therefore, I'll come here, I'll say deduct the fair value of the acquired, which is what? 30,000. And that gives me 470. I can now compare 470 with 400, and it's going to give me the same 70. And that is it, which means regardless of the approach you use, you are going to get the same thing, which means there's actually an increase in group inventory of 70,000, not 100,000. And how do we treat this? An increase in group inventory is similar to an increase in group trade receivable because they both constitute what? An asset. Therefore, operating activities and outflow of what? Of cash. Any question on this? Any question on this? Now, let's go back to our question. Can we look at question 4 in similar vein? And let's see how we can treat that. Jonathan, are you there? No? Okay. King Solomon, can you unmute?
Yes, sir.
Okay, proceed.
Okay. Illustration 4. NIA acquired Farayola in the current accounting period. Extract from the group accounts of NIA shows non-current assets 31st December 2017. Then we also have for 31st December 2018. The depreciation of 5.2 million was charged to the consolidated income statement in the year, and the net book value of non-current assets disposed of is 1.2 million naira. The fair value of Farayola's non-current assets when Farayola was acquired by NIA stood at 9.6 million. Required, determine the group expenditure on non-current assets during the current accounting period.
Thank you. Okay. Now I believe you can see my spreadsheet. Okay. Now, what should I do? I'll do the same thing here, which is I need to determine my PPE. Property, plant, and equipment. Now, I want to see the movement in my property, plant, and equipment to identify which one is the cash element in it. Therefore, usual from your IAS 16, I need my balance brought forward. And what is the balance brought forward? It is 20 since 2017 to 2018. Now, we are told that during the year, Farayola was acquired. Therefore, similar to what we did here, I can add, if I'm using this approach, which is what I will adopt, I will add the fair value of the acquired subsidiaries PPE, which in this case is 9.6 million. Remember, all figures are in thousands. Let me indicate that. Therefore, that's 9.6, 9,600. Okay. Okay. Now, at the end of the day, that sum up to 296, 29,600. What then do I need to do? In that year, what are other impacts in that year? Transaction impacts in the year. What has happened in that year associated with transactions? One of them is that there is a depreciation charge in the year. How much is the depreciation charge? 5.2. The question I'll ask is 5.2, will it increase or decrease my assets? It's going to decrease my assets. Second one is disposal in the year. The kind amount of assets we disposed in that year was 1.2. What will it have as effect? The disposal of assets. The kind amount will be used to reduce the kind amount of the disposed of assets will be used to reduce the kind amount of other assets in the book, which means so that what we have left are kind amounts associated with other assets. Therefore, I take out the 1.2, which means the total deduction that will have reduced my kind amount of assets is 6.4 million. Therefore, the sum is 23,200,000. That will have been my expected value as usual. Therefore, where did I write my expected? My actual and expected. Okay, therefore, let me now compare my expected balance with my actual balance. In my balance sheet, what is my actual balance? My actual balance is 32 million. And therefore, I put 32 million. At the end of the day, I make comparison. What is the difference and how do I treat it? What is the difference in this? We have a difference of how much? Now for PPE, we have difference of 8,800. What does that mean? It means that our kind amount supposed to be 23,200, but what we have is 32. What does that signify? It signifies that we have probably acquired additional assets for cash. And therefore, that difference will be attributed to cash purchase of items of property, plant, and what? Equipment. And what activity is that? Investing activity. And is it an outflow or inflow? When you purchase assets, is what? An outflow of cash. And that is that. Any question on that? That is the solution to that. Any question? Okay. Now let's move back to our notes. Let us see how we treat disposal in this case. Who will volunteer? Okay, Taiwo D, over to you. I've given you access to a minute. Are you there?
So, yes, I'm here, sir. What do you want me to read, sir?
Okay. Starting from partially owned subsidiary. Okay, I think I've done that. Disposal of subsidiary.
I can't even, I don't have a material open. No.
Okay, it's on the screen. Can't you see the screen?
Yes, I can. I'm not seeing it well. Is it possible to
Can you enlarge your phone? You can magnify your phone.
I'm using my laptop.
Okay. Okay, no problem. Let me find Justin. Are you there? Okay, Chibueze, over.
Thank you, sir.
Hello, can you hear me, sir?
Yeah, I can hear you, Chibueze. Proceed.
Okay, thank you. Disposal of subsidiary. Disposal of a subsidiary is treated using the same principles as for an addition. Cash flow in relation to disposal of a subsidiary from the group perspective is to the extent that cash is received as consideration. This will be shown as an inflow under investing activities. If any group assets or liabilities are being analyzed to determine a cash inflow or outflow, the book value of the subsidiary's assets or liabilities will need to form part of the analysis. For example, tax liabilities in the subsidiary at the date of disposal will represent a debit in a tax account written up to determine tax paid.
Okay, similar to what we have done, is the same thing we'll be doing for disposal. Okay, and as you can see it here, we can now look at for disposal. Let me go back to my notes. We are going to do the same thing for disposal, which means when we have disposal, of a subsidiary. What does that mean? It means that at the beginning of the year, the group structure beginning of the year, which is boy, I have P, the parent, S1, S2, and X3, which make up the group. But at the end of the year, I now have P, S1, and S2, which now make up the group. What happened? S3 existed at the beginning, but before the end of the year, it has been disposed of. Now, when we are now comparing balance of an asset or liability at the beginning with balance of asset or liability at the end, they are not comparable because 4 entities make up the group at the beginning, whilst 3 entities make up the group at the end. Therefore, it's like comparing red apple with green apple. We need to make that adjustment. That adjustment then is at the point of disposal. At the point of disposal, the carrying amount of the disposed of subsidiary have to be adjusted as thus. Option 1, remove from the opening balance, which means delete the kind amount from the opening balance, which means take this off. And what it means is at the beginning of the year, before you have P, S1, S2, X3 to give you the group, we are now saying delete it. So that what is left is comparable to the balance at the end, which is P1, P, S1, and what? S2. Or option 2. Option 2 is to add to the closing balance as if it has not been disposed of, which means beginning balance is P1, P, S1, S2, and X3 to make up the group. Therefore, at the end of the year, it will be P1, X1, and X2. But I have to now incorporate by addition S3. But what am I going to incorporate is the carrying amount of the disposed of assets, as if the asset has not been disposed of. It's on that basis that I'm comparable, all things being equal. And that's just what we're trying to do, similar to acquisition. On that premise, we finished the introductory aspect of consolidated statement of cash flow. What then now happens is that in our next class, probably tomorrow, we will now look at this comprehensive problem, either this one or the one that was examined 2 or 3 days ago, in which many students find it difficult to attempt. And that is the consolidated statement of cash flow. Okay, it's more likely whether I'm going to use adopt the one that was examined, or because this one, I've done it before, also on video that you guys have access to online on YouTube. But the other one, I've only done it physically in class in 1 or 2 days ago, which I've not had the opportunity of doing the video, which that means am I likely to pick that one? And I think it was November 2024 dates, or November 2024 date or May 2024 date, one of those dates, is where the examiner examined consolidated statement of cash flow. But in this particular one, which is very comprehensive, it has all of the principles we introduced at the start of the session, which means how to treat non-controlling interest, how to treat associates within that statement, how to treat acquisition and disposal of subsidiaries during that year. Any other question before we call it a day? Any other questions before we call it a day? And I can encourage you guys, 1, 2, 3 persons or more, to try and attempt it based on your little understanding at this point in time. Okay, in the absence of no question, we'll call it a day. Thank you, and God bless you. Bye.